HMOs, or houses in multiple occupation, are they still a great investment strategy for 2025? A lot has changed in the last couple of years, so how do you best tweak that strategy to make it be on fire in 2025 and beyond? That's the subject of this video, so stay tuned. But first, if you're new to this channel, make sure you subscribe and hit the bell icon. We put out new videos each and every week, all dedicated to keeping you on top of your property investing game. Now, HMOs have always been a good strategy because if you think about it, instead of having a house that you let out to one tenant or family on a single tenancy contract, instead you split it up into rooms and you let it out room by room to multiple occupants, thereby making more gross rent. The concept has been around for donkey's years. Back in the old days, it used to be called bedsits. People call it HMOs now. Even people call it co-living, but it's all basically the same thing. Now, compared to doing the HMO strategy just 5 years ago, a lot has changed between then and now. And a lot of those changes aren't for the better and affect the viability, the economic viability of doing certain HMOs. So listen up to my summary of what's changed. Tell me in the comments whether you agree or disagree. Let me know whether you are still doing HMOs in 2025. And at the end of this video, I'll tell you how to apply this strategy best now and going forward. But if you were doing this strategy 5 years ago, your mortgage costs were a lot less than they are now. Mortgage costs on average will have gone up 3 percentage points from 5 years ago. You're now looking at 5.5%, even 6% interest rate on a HMO mortgage. Of course, debt serviceability is the largest single cost you will have on a property investment, and any changes there obviously has a serious effect on your profit. Now, the second thing that has changed is the cost of utilities. Now, if I let out a single house or a single flat or whatever, the tenant is responsible for all the bills. I kind of let and forget and they look after all of that. But when you run an HMO, you normally as landlord pay for all the bills. It's basically an all-you-can-consume buffet for your residents. So you're paying the gas, you're paying the electric, you're paying the water, council tax, you're usually paying for internet as well. By the way, what I find very intriguing is how many environmentalists there are in HMO properties, living in HMO properties, talking about saving the planet, but can't be bothered to turn the light off or the heating down when they leave the house because they're not paying for it. But in the old days, if you had a 5 or 6 room HMO, there was enough meat on the bone to basically sustain these utility costs and run it like a sort of all-you-can-consume buffet, as I said before. But the thing is, compared to 5 years ago, utility costs have tripled. And the tripling of utility costs and the fact that utility costs are likely to rise going forward still further means that that is only going to ever shrink your bottom line margins. Now, council tax is something to think about. Now, when you rent out an HMO, the landlord normally pays for the council tax. We had a little scare a couple of years ago when a lot of local authorities were looking to impose Band A council tax banding on every single room in an HMO. This would have been a nightmare for landlords and put on us a lot of additional costs. Now, fortunately, that did not go ahead. There was a campaign against it, hasn't gone ahead. But now that that is squashed, the greedy councils are looking for other ways to basically raise their income, and what is most likely round the corner is that there is a new council tax band especially for houses in multiple occupation. So if you have an HMO license, that would be subject to a new council tax band, and you can bet your bottom dollar that will be at a higher rate than the existing bands. Now, of course, HMOs have to be licensed, and these licenses have to be renewed every 5 years. And of course, the councils are ever more cash strapped, and they seem to be putting up and up the costs of getting this 5-year license. Now, the final thing that you need to think about is something that a lot of people aren't really thinking about, and it quite surprises me. And this is mortgage arrangement fees. Now, when I started out in property in the 1990s, if I had to pay a £199 arrangement fee to get a buy-to-let mortgage, well, that used to annoy me because arrangement fees weren't charged. I mean, if you think about it, you're getting a loan from them, you're paying them interest every month, that should be enough. But these days, you see buy-to-let loans where there's an arrangement fee of 1, 2, 3, and I've even seen 7% of the loan. Now, you tend to find that when you look at HMO mortgage products, the arrangement fees are on the higher side than if you are looking at mortgage products for single lets. Now, this poses an interesting problem. If you are paying 5% as an arrangement fee just for a 5-year buy-to-let loan on an HMO property, then you're paying 5% of the loan. Now, they add it to the loan and you don't really notice, but what that means is that at the end of that 5 years, if your property value hasn't gone up by at least 5%, you will struggle to remortgage it. What I think people should do is actually take the arrangement fee, say for a 5-year loan, and divide it by 60. So you have a month-by-month cost of what that mortgage is actually costing you to have arranged. I've been doing HMOs for a long, long time. 10 years ago, 15 years ago, 15 years ago, I would do a 3 or 4 room HMO, and those would be economically viable. Then things changed a little bit, and pretty much the advice became, look, you need 6 rooms. You need 6 rooms in an HMO for it to be economically viable. And the reason we say that is because you have a certain amount of fixed costs just for running the HMO as an HMO. So you've got to have rooms to let which cover those fixed costs and some extra to make a profit. Now, in the days when you can work on a 3-4 room HMO, your fixed costs were very, very low, so that still worked. 6 rooms has been the story up till now, but increasingly you will find it very, very difficult to make the figures work on a 6-room HMO. And even if you do make them work today, even if you just squeeze through by the skin of your teeth, you will find that in a couple of years' time, it will be very, very marginal as to whether it works. And of course, do remember that HMOs do require quite a lot of capital upfront investment. Of course, when you buy the thing, you've got to pay stamp duty, and thanks to Rachel Thieves' budget, there's an additional 5% surcharge over and above the stamp duty that you would pay. You have to pay an additional 5% just because it's an investment property. You've got to put in at least 25% deposit, and then you've got to refurbish it, put in en suites and stuff like that to bring it up to a certain standard to achieve the premium rents. So doing HMOs is quite a capital intensive project. The other thing that's changed is your ability to refinance. Remember, a lot of people have been doing HMOs based on the principle of, well, you buy a dilapidated property, you put in 6 rooms, you do the en-suites, you get them all done very, very nicely, and then you get it revalued, classic BRRR. You get it revalued at a much higher level, and you get it revalued at a higher level because you get the valuer to value it on the cash flow that's being brought in by the 6 rooms. So this is all very good. You would get a revaluation based on the cash flow, a yield-based commercial valuation, and then you could usually pay off your loans or private investors and cover the capital costs of doing it up and all that sort of stuff, and come out with very little money invested in the deal and a good positive cash flow. It made sense for everyone. But in the last month, the way surveyors value HMO properties has changed. What used to happen is that if you're looking for a commercial valuation, the valuer would come round, they'd value it based on the rent roll, and all they would look for is other commercial valuations by other valuers in that area. So as long as there's a comparable valuation, which has also been done on a yield basis, then they could value it at a similar level. What's happened now is the surveyors have met up and decided we're not going to do it that way anymore. We need to look at sale comparables for these HMOs. So the problem with that for people is that if you look at sale comparables, there are very sales going on of 6-bedroom, 8-bedroom HMO buildings. So it's going to be very difficult now to achieve the sort of yield-based valuations that you would have been getting just a year ago. So all this means is the viability now of even 6-room HMOs, I don't believe is there in many parts of the country. So what do you do if you want to do the HMO strategy? Well, if you want to do the HMO strategy in 2025 and beyond, it's go big or go home. When I look at HMO deals, quite frankly, it's 8 or more rooms that work in today's market. 8, 9, 10 rooms gives you the economies of scale, gives you the quantum of rooms and cash flow to make the increased fixed costs of running an HMO building worthwhile. Now, when you have a larger HMO, like an 8-room or 9-room, it's not considered as cozy, shall we say, as a smaller HMO for the tenant. So usually the rents on rooms in larger HMOs can be a little bit lower than some of the premium rooms rents you can attract in smaller HMOs. But you can offset that if you've got a larger property and you can offer more communal spaces and more appealing communal spaces. You can offset that to a certain degree. Now, when you're doing the larger HMOs, of course, anything above 6 rooms will need full planning application. You can't just do it. You will need a full planning application, and there are certain types of properties in certain types of neighbourhoods that will never get that planning permission. So you have to know what you're doing and seek the properties where you will get permission for the larger HMO. The other thing to bear in mind is when you go over 6 rooms, the building regulations and safety compliance rules are far more stringent than doing a 6-room HMO. So you have to bear in mind that additional cost. But when I look at people's figures for HMO projects, increasingly now I'm seeing 5 and 6 rooms doesn't cut the mustard. It's the larger HMOs that are still profitable. So HMOs is now becoming a go large or go home kind of strategy. If you're doing HMOs, I'd love to know your comments, your experiences. Let me know in the comments below. That's it for this video. Make sure you subscribe, guys. Now, I know from our stats that less than half of you who watch this video are actually subscribers to this channel. Subscribe, hit the bell icon. You'll get notified when we upload new content, which is each and every week. See you guys in the next video. The Baker Street Property Meet is the UK's largest and #1 property investors networking event. The property market is going through monumental change right now, and at Baker Street Property Meet we aim to keep you up to date with the latest tips and tricks and insider tactics to help you keep on top of your property investing game and succeed in these troubled economic times. The Baker Street Property Meet is fundamentally about networking, because it's not what you know, it's who you know. And at Baker Street, we aim to connect you with the people to make your property journey a monumental success. There's no better place to be to further your property investment journey than the Baker Street Property Meet. So make sure you're here, you're connecting with myself and Andrew Roberts, our expert guest speakers, and 300 passionate property people each and every month. See you at the next meet. Get your spot at bakerstreetpropertymeet.com.